Next question. On 12th of January, Mr. X is entering into the futures contract for the month of March. The futures contract is entered upon, and that is for the month of March. So as what we already have discussed, the stock futures will expire on the last Thursday of the March month. Details about the futures contract entered upon is as under. The transaction is said to buy the underlying asset. The transaction is said to buy the underlying asset, that is security A, and that is given a technical name as the long position in the futures market. The price at which you are going to buy is say 1200. On 22nd of February, Mr. X enters into following futures contract for security A once again, for the month of March once again. So the contract is entered upon for the same security and for the same time period, that is say for the month of March. The transaction is say the sale of security A, and that is given a technical name as a short position in the futures market. The price at which you are going to sell is 1250. Suppose on 28th of March, that is last Thursday of the March month, price of the security is 800, 1200, 1220, 1250 and 1500. For each of the market price, calculate overall profit or loss. Overall means say taking into account both the transactions together. Lot size is 150 shares. So I want you to write in the chat box that what will be the overall profit or loss taking both the transactions together for individual spot price, that is 800, 1200, 1220, 1250 and 1500. For all the spot price, say you are required to give answer in the chat box. Initially you give answer for two spot prices. Let us say that it is 800 and 1220. Only for these two spot price you write answer in the chat box. So let us have understanding that say how to make calculation of the answer for this question. Please write an answer. Calculation of overall profit or loss for both transactions taken together. See over here in the column number 1 I am writing the spot price, on 20th of the March, that is the date on which the forward/futures contract, that is futures contract over here, is expiring. The first contract that say you had was purchase. In that sale price, purchase price, profit loss. The second transaction was sale. In that again sale price, purchase price, profit loss. And lastly you will have the overall profit loss. That is the way say we can have the profit or loss to be computed for each spot price of the security. Now the spot price of the equity share is provided to us as 800, then it is 1200, 1220, then 1250 and 1500. The first transaction is said to purchase a security, and the price at which you are going to buy the security is an amount of rupees 1200. That is the futures contract which was entered upon to buy the security at 1200. So over here 1200 is the purchase price. And we understand that so for the purpose of notional profit or loss calculation, we do the reverse transaction immediately, and so the sale price is 800, 1200, 1220, 1250 and 1500. So ultimately in the first case you will have a loss why the prices have fallen down. No profit, no loss. there is a profit of 20, profit of 50, and there is a profit of 300. The second transaction in which you have entered upon is, say, to sell the security at 1250. So that is the price at which you are going to have the sale of the security irrespective of the spot price of the underlying asset. You are going to buy at spot price, that is 800. So that will result into a profit of 450. You purchase at 1200, then in that case the profit is of rupees 50. You purchase at 1220, so there is a profit of 30. You purchase at 1250, so no profit, no loss. You purchase at 1500, so there is a loss of 250. So now what will happen? We can say that, say, 450 minus 400. So there is a profit of 50. 50 and 0, so it is 50. 20, 30, so again 50. 50, 0, so 50. 300 minus 250, so it is again 50. So overall there is a profit or loss on per share basis, an amount of 2, that is 50 rupees. Lot size is provided as 150. So overall gain or loss is 50 rupees into 150 shares. That comes to rupees 7,500. This is the way the overall profit or loss can be calculated. So now importantly we understand that whatever may be the spot price of the security, you have a profit of fixed 50 rupees per share. Why? Let us understand that now carefully. Because we understand that there are two prices at which you have entered into the reverse transactions. See, initially you have taken long position, that is, say you have purchased the security at 1200 and then you have sold security at 1250. So what happens at, understand carefully, at the rate of rupees 1200 you are going to buy the security and you are going to sell at the spot price on 20th of the March. So I am writing over here spot price. Of which date? On 20th of the March. Listen carefully. The other transaction is to sell security at 1250. And what is the price at which you are going to buy the security? You are going to buy the security at again the spot price of 20th of the March. This is the way the profit or loss will be calculated on per share basis into lot size, that is 150 shares in this example. So when you open the bracket logically, spot minus 1200 plus 1250 minus spot into 150. So this spot is getting cancelled and there is a profit of 50 rupees per share into 150. That comes to rupees 7,500. It means that on 22nd of February, when you have entered into the reverse of the original futures contract, then in that case, you will be having, say, a firm profit of rupees 7,500 only. And importantly friends, you don't have to wait till March end for the purpose of, that is, say, getting this amount of the profit. This amount of the profit will be given to you on 22nd of the February itself. Why? Because, say, your profit of rupees 7,500 is fixed irrespective of the spot price of the security. Understand it carefully what I am going to speak further. On 12th of January, you entered into the March futures contract to purchase the security at rupees 1200. On 22nd of February, the futures price is 1250. Listen carefully. The contract of purchase is already there in the market. On 22nd of February, the March futures price is rupees 1250 and you are expecting that say now the price of the security will fall down in the market. That is the reason, so technically you square off this transaction. What you have done? So you have squared off this transaction. Initially you had entered into the transaction to buy, so now you will enter into the transaction for sale, and you know that at this point of time I will be able to make a profit of 50 rupees, and so that is the profit that say you gain so on this futures contract which was initially entered upon. Importantly, if at all say on 22nd of February you are expecting further that the market will be bullish and the price of the security will further increase, then in that case you will keep your long position as it is, so that say you will be able to make further gain. But now you are expecting that say the market will fall down, so you want to take this amount of the gain and you want to say square off your position. Remember that, listen carefully what I am going to speak. On 22nd of February, let us assume that the futures price of the security is, let us say 1160, suppose. It means that on 22nd of February, if at all you square off the transaction, then in that case you will be having a loss of 40 rupees on one share. If at all you are expecting again the price of the security to fall down further, then in that case you will book the loss of 40 rupees on per share basis, and again you will square off your transaction. So you will enter into the transaction set to square off. In between, if at all you are expecting that say more than this gain is not possible or more than this loss will be there in future, that is the reason say you square off the transaction in between. This is what say we understand. So friends, now we understand that over here, based on this question, that the futures contract can be squared off in between also, and to square off that say in between the futures contract, you have to enter into opposite of the original contract. Second thing, that say you have to enter into the futures contract for the same time period, that is over here for the month of March, and of course for the same security, that is security A in this example. Difference between the sale price and purchase price will be the profit or loss. If at all the sale price is more, you end up with the profit. If at all the sale price is less, you end up with the loss. And of course, so there will be certain transaction costs which is required to be considered for this, so the overall profit or loss calculation. So let us answer the question. From above calculations, comma, we can say that whenever two opposite transactions are entered upon, comma, in that case difference between sale price and purchase price will be profit or loss. Full stop. With paragraph write down. This amount of gain will be given on 22nd of February, comma, if it would have been a loss, then loss is required to be paid on 22nd of February. Full stop. Importantly, in between futures contract is squared off because trader believes that now profit will reduce or loss will increase. So friends, what happens at say basically when you are squaring of the futures contract, at that point of time it may happen that you have a profit situation. So you have a profit situation, so you square off? No, you have a profit situation and you are expecting that say now the profit will not increase further, so you square off. You square off in a loss situation, are you foolish that say you are squaring off right now? No, I am expecting that say my loss will be further increasing if at all I do not square off right now. And understand friends that the square off means entering into the reverse of the original transaction. Initially you had entered into the sale transaction, so now you are going to buy. Initially you had sold, that is initially you had purchased it, so now you are going to sell. That is what we understand. Just for understanding purpose, on 2nd of November in the cash market, the price of the Reliance was this. Suppose at that point of time, suppose I had purchased the security, then I had to purchase it at 2539.25. That was the price at which I am supposed to buy the security. Now, right now the price is 2505.20, 2505.85. So on 9th it is 2505.20 slash 2505.85. This is the current price. So suppose at that point of time I had purchased it at this rate. Today if at all I sell it at 2505.20, then difference of this is what we understand is a loss that I have. There is a loss of approximately 34 rupees and 5 paise. If at all I take if I would have taken the long position on 2nd of November. In case of the cash market trading, you will be having the profit or loss say even for one equity share, because you can deal even for one equity share. This is what we understand. This is I am talking about the cash market. Now suppose on 2nd of November I entered into the transaction to sell underlying asset, that is the Reliance security for the month of November. We know that for the month of November, the last Thursday is 25th of November. So for 25th of November, I have entered into the transaction for sale. And when I book the transaction for sale, then of course I will be given the lower price, that is 2551. That is the price at which I entered into the transaction for sale. Now suppose I square off my transaction. So today I will purchase the security in a way that I enter into the contract for the purpose of purchase. then in that case, say what will happen, let us see. So I go in the derivative, in that say I am going for the futures contract. So at this point of time, say initially I had sold, so now I have to buy. What is the buy price? 2513.60. So 2513.60. So what will happen? It is 2551 minus 2513.6. So I will be able to make a profit of 37.4 per share, and the lot size is 250. So into 250, that will result into a gain of 9350, of course subject to the transaction cost. So on 2nd of November, if at all, say I had entered into the transaction for sale, and today say I square off my transaction with buy, then that will result say into the profit. If at all I am expecting further the price of the security to fall down, then in that case I will not square off the transaction. I will square off the transaction if at all I am expecting now the price of the security to go up.